Thank you, Shanda. Hello, everyone. Welcome to our Around the Valuation World, our May show. And for today, we have a great show, as always. For our lineup, we will have Michael Gregory. He's always with us every month, and he's going to be presenting the industry headlines. We're also going to have Cheryl Hyder and Stacey Ferris. They are going to talk about valuations of non-fungible tokens. We're going to have Zipp and the judges talking with us. And Jason LeRoy, he's going to talk about standards and ethics bulletin. And at the end, we are going to have Garrett Wagner, and he's going to discuss innovative knowledge for today's CPAs. So now I'm going to pass to Michael Gregory. You already know him. He is awesome, and he's going to talk about our industry. So hi, Mike.
Hello, Elena. I'll share my screen here.
Thank you.
And does everybody see just one photo, or do you see two?
Go
ahead.
Yeah, we're watching, we are seeing your presenter's screen.
Okay, I'm going to swap those. There we go. Does that work?
Perfect. Thank
Beautiful.
you.
Thank you, Elena. Thank you, Chinda. Hi, I'm Mike Gregory. For those of you who are new, I worked for the IRS for 28 years and headed up business valuation for 11 nationally. And I've been in the private sector now for more than 10 years. Today, I'm a person who focuses on conflict resolution with the IRS and with others related to business valuation. For today's session, we've got 6 different things we're going to cover. These involve tax returns as a source of historical data. The CFA Institute issues Kroll's Global Cost of Capital 2022 Summary Edition. The tax court accepts tax affecting grudgingly, and I'm going to offer some personal insights in this to help you as well. Have you tried Abbott's Passive Appreciation Calculator? And I've got some links to a peer-reviewed article and also to this calculator. And if you're involved with personal goodwill and growth relative to privately held entities, you might want to take particular interest in this. And then big IRS flag and fractional interest valuation. I was a real property valuer appraiser as well for 19 years and had a federal general certification. So I'll talk about some implications with this. And then Fernandez, this is Pablo. Pablo Fernandez released a survey of the 2023 risk premium and risk-free rates. Then there are a host of references that I have for you today as well. So let's start out. What are our objectives? Identify tax returns as a source of historical data. This is something I've always used, and you'll find out that many people do this as well. Reference Kroll's Global Cost of Capital Summary Edition. I've looked at it myself, and I'm suggesting you download that. Did the U.S. tax court grudgingly accept tax affecting? Well, I'll talk about that with this court case. Consider Abbott's Passive Appreciation Calculator. It might be something you want to download and play with. He's making it available for free. And note the IRS reg flag regarding fractional interest. And finally, reference Fernandez survey of the 2023 risk premium and risk-free rate. So starting off with tax return data, let's take a look at that. Here's what a survey found relative to business valuers. 91% of valuation experts say federal returns are crucial or very important. 81% look at various forms, and what I would say is, regardless of what forms the taxpayer has, it's probably a really good idea to get a copy of the complete return. 55% pull up form 8825, which for rental activities. 95% obtain these via PDF, and that's fine, and somebody can key those in for you, but it's also even nicer if somebody can provide that to you in a different form. And 91% do not use software to extract return data. The bottom line is a lot of folks use it. It's a really good source. It's something that also addresses concerns that what are they reporting to the IRS for tax purposes. The CFA Institute issues Kroll's Cost of Capital 2022 Summary. It's 179 pages. It's a free publication from Kroll. It runs through June 30th of 2022. I've downloaded it. I've skimmed the entire thing. I've read certain sections. I'm encouraging you to do the same. It's the abridged version of Kroll's Cost of Capital Navigator. And here are some of the risk characteristics that are associated with the publication. Internal costs of capital overview, strengths and weaknesses of commonly used models. For those of you involved with international issues, it's international equity risk premia, country yield spread model, relative volatility model, that's helpful, the Harvey-Visconti country credit rating mode if you're involved with international issues, and firm size and the cost of capital in Europe if you're involved with any valuations again overseas in Europe. Now this is the really interesting one. I have two slides on this one. In the estate of Cecil, the taxpayer had two different appraisers. The IRS had one appraiser. And we don't have time to go into this court case. That would be a really nice session to have detail on. But I'm suggesting you're going to want to download and read this case if you have not already. I had to read it 3 times before I took some action, and I'll explain that in a moment. But in this commentary, in just a second, in this commentary, here's a quote from within the case. We emphasize, however, that while we are applying tax affecting here, given the unique setting at hand, we are not necessarily holding that tax affecting is always or even more often than not a proper consideration in valuing an S corp. Both experts, both sides used the C model from Daniel Van Vliet's model. The judge applied the 17.6% factor of saying an S corp is more valuable than the C corp. In the decision, the judge says he applied a 17.6% tax rate. It's not what they had. The judge applied a 17.6% factor using the C model. The judge says, nope, this isn't a precedent, but I got this and I read through this, and I'm going to take you now to the conclusion and give you some commentary on where this is at, because I was very confused after I read this case. Now we just read again the top line. We're applying tax affecting here. Again, we are applying tax affecting here. This is in the body of the court decision. In the conclusion, it states, and this is again a quote, we accept the valuation reached by Mr. Adams, that's the taxpayer's appraiser, one of them too, before he took into account any tax affecting and before he applied any discounts. Let me read that again. We accept the valuation reached by Mr. Adams before he took into account any tax affecting. So it sounds like we didn't tax affect, and before he applied any discounts. Then there were a discount of Mr. Adams, 20% discount for a lack of control. So there's a DLOC. And Mr. Morrison's discount rates of the DLOM, 19%, 22%, and 27% for lack of marketability. That's because there was a Class A stock, and then a Class B stock with a small portion, and a Class B stock with a large portion. That's why you have these 3 different DLOMs in here. So I read this and I said, what's going on? In the body, it said we tax affected. In the conclusion, it says we didn't tax affect. So this came out on February 28th. I read it 3 times. I'm still confused. So I contacted the U.S. Tax Court on March 1st, and I said, I don't know what happened here, but I read your report. I read the tax court memorandum publication, and there's a disconnect here. And I pointed out these 2 different quotes. And from that, I said to the tax court person, perhaps somebody can get back to me because I'm confused as to what happened. The next day, I get a call from the U.S. Tax Court, from a clerk from one of the judges. This clerk understood what I was talking about and said, I understand what you raised. I will follow up. Thank you very much. Well, that was on March 1, or that was on March 2nd. So since March 2nd, I said, a few weeks later, I'm going to call up Mr. Adams. I'm going to ask Mr. Adams, what happened in the case? Did they accept tax affecting with your valuation, or did they not accept tax affecting? He said, well, Mike, the story here is we're still working on it. This is not normal. And after tax court decision to figure out, now, what are we really doing here? But he said, all I can tell you is it's still a work in process with the U.S. Tax Court. So there's a publication out there that says what I just told you. And I worked for the IRS 28 years. I ran a litigation group for 7 years. I've never seen a situation like this. And so I'm just pushing back at you with, I don't know what really happened in the case. I don't know that anybody knows what's really happened in the case or can say this is what the tax court did. But at this point, it's a work in process. And what Dave Adams has said to me is, Mike, once I know what's happened on this case and I'm doing the computations, I'll get back to you and let you know when I can let you know. So that's what's happened on the case. I'm not sure. How's that in terms of what's happened with this case where it says the tax court accepts tax affecting grudgingly? I'm putting a question mark on that. Did they or didn't they? I don't know. Next item. Have you tried Abbott's passive appreciation calculator? This is from Dr. Ashok Abbott from West Virginia University. And the IRS has said relative to his work, we need to follow this guy because he comes up with really good ideas. He presents these out to the public, and he offers the chance for others to comment on what he does. So he's offering you the chance to test a link and saying, what is the appreciation that's associated with an entity in the industry? And then how well has your firm done? And then you can compare that and say, how much might be personal goodwill? So I'm suggesting you might want to read the peer-reviewed paper that's been published, and I have a link to that in the references, and then choose the type of business that you're in, enter the beginning and ending dates of the valuation. So let's say when the marriage started and up to whatever date for when the divorce is being applied. And then it gives the passive growth factor on a national basis of that industry group, and a time period that you've selected. It says, note that this is national. And what he's working on is actually applying data for data mining that could be data mined at a regional or local level. That's a work in process that he's working on. This is a beta testing model. He's suggesting at least this much growth would be passive appreciation in the divorce case. So think of it from that perspective of this one more tool you can use to take a look at what might be associated with growth because of the average of what's going on in the industry compared to what was involved with personal goodwill. Big IRS red flag in fractional interest valuations. Fractional interests are something that take place in real estate. I occasionally get a question from somebody that asks me about fractional interests. And I have a number of studies that are dated because back in the time period of 2012 or 2013, I made a presentation to the Appraisal Institute on exactly this topic. But I've let my credential expire. This is not my area of expertise or the area I decided to stay in. I decided to stay in the area of business valuation. But Dennis Webb, he's an expert in this area, works for Primus Valuations. He has 25 years experience. And he's saying you need to address what the facts are with the partners and what their intentions are on a fractional interest in real estate. Don't assume a generic situation. His text is entitled Valuing Fractional Interest in Real Estate 2.0 and he has an outline, or I have an outline for you that he's given to us in the references. And he has trial online software that's free. You can try that also in the references. But I'm going to push back. And if you're a business valuer, you have a fractional interest in real estate, you really want to bring on board someone that has expertise in this area. As I said, there are a number of studies. I have historical information. There's more up-to-date information than what I have. But in sharing this with others who are business valuers and have asked me questions on this, I've said, really need to bring on board someone who's an expert in this area. And there may be studies or data that's been collected in your geographic area. So, for example, I have some studies that deal with what's happened in the state of Washington or what's happened in Oregon or what's happened in certain other areas that appraisers accumulate this data and they share it amongst themselves in the real property arena. And the most current data is what you'd really want to obtain. Then we move into the study from Pablo Fernandez. Pablo Fernandez releases the survey of the 2023 risk premium and risk-free rates. I follow this every year. Every year he asks for information from business valuers, and you can contribute to this too if you'd like. And then he takes this information and he says, here are the risk premiums and the risk-free rates from over 80 countries with what he's gotten as responses from a number of different sources. And he says, for right now, the US responses are averaging a market risk premium for 2023 now. This is looking at what would it be for 2023. It's a forward-looking analysis of 5.7% and a median of 5.5%. So we've got a mean of 5.7 and a median of 5.5. And he shows you the full range of those, and you can use that from another source for you to consider, as well as you're looking at the Moderns information and other sources. The paper also provides links to previous surveys, 2008 to 2022, has a lot of good information in his publication. He talks about all different kinds of models, pros and cons of models, and a number of different things. You can see the link to the paper here again in the references, and that's all free. So in terms of the references today, I've got quite a few. Here's the Valuation Handbook, International Guide to Cost of Capital 2022 Summary Edition. Again, that's through June of 2023, and that's free, 179 pages. I'm suggesting you download it, take a look at it, and keep it as a reference. Then here's the court case, the estate of Cecil versus Commissioner, Tax Court Memo 2023-24. And I'm commenting there seem to be some discrepancies within the text of the memorandum. There also seem to be some things that are still being worked on, and what's going to happen on that, I don't know. When I know something on that, I'll come back and share it with you. Waiting for David Adams. Ashik Abbott, Appreciation Calculator. Here's the free test. You can download that and you can play with that yourself of what might be associated with the growth in this industry on average for an entity and compare that to what your firm has. And then here's this peer-reviewed paper on that calculator. So you can read through the theory behind it, the application of it, and then you can try that with the calculator. In Valuing Fractional Interests in Real Estate 2.0 by Dennis Webb. Here's the free outline from the Appraisal Institute of this book and what's in it. And I'm suggesting if you get involved with real estate and fractional interest, you need to really bring on board someone who's an expert in this area. And then here's Webb's free online software application. If you want to take a look at that and see what might happen in terms of you generally taking a look at it to see how sensitive this might be. And finally, here is Pablo Fernandez's survey, Market Risk Premium and Risk-Free Rate, used for all 80 countries for 2023. You can download that. And I'm suggesting if you want to, you can be part of the source of providing him with information. I appreciate this is not just a summary. This also has lots of other interesting information and addresses a number of issues related to business valuation. And then each month, these are the different sources that I use: BV Wire, BV Update, those are from BV Resources, the Value Examiner Monthly, NACVA CTI Training Summaries, Valuation Products and Services, publications from the IRS and other sources. And next month, I'll be going over Gary Trugman's book with the commentary that he has on one particular element and sharing that with you from another article, as well as the sources that I normally use. And if you need to get back in touch with me, again, that's my phone number, that's my email. I look forward to any questions or comments that you might have even after the session if you want. I normally get 2 or 3 calls, and it will be my pleasure to address those for you. So with that in mind, I see there's a poll question. Please answer that if you would. And with that, I'm going to stop sharing my computer, and I'm going to pass it back to either Elena or to Mel and say thank you very much. Have a great day.
It's passing it back to me, Mike. Thank you so much for another great session. A lot of good resources there that we need to go deeper on. So our next segment is going to be, an interesting one, how to value non-fungible tokens. And this is kind of a unique area that is growing. And Cheryl Hyder is going to be the correspondent that is going to interview Stacey Ferris on this. Cheryl has been in the business for 25 years, primarily in forensic investigations, financial investigations, and like. Cheryl, are you there?
I am here.
Well, take it away, Cheryl. I'll let you introduce Stacey.
Okay. All right. Let's see. What screen are y'all looking at?
We're not seeing a screen yet.
You're not seeing a screen. Hang on a second. You should now.
It's coming up now.
Okay.
Now we see your desktop, it looks like.
Okay.
Now we see.
There we go.
There you go. All right. Sorry for that. All right. So everyone knows what I look like. What we're going to talk about today is something that's really, really cool. It's a rabbit hole. You will get caught up in it because it is incredibly interesting. Stacey, where are you at? I'm going to pop on the screen here.
Hey,
there you are.
right here.
There you are. I'm going to be speaking with my friend Stacey Ferris today about this very, very interesting area, non-fungible tokens, NFTs. We've all heard about them. And the purpose of today is just to give you a taste of what's coming in this webinar that I talked Stacey very nicely into doing for us tomorrow, so everybody can get a handle on what is this new world that we're in with all of these digital assets, not cyber assets, as they're now called digital assets again. So we're going to learn more about that. And our guest today is Stacey. Stacey Ferris. She is a analyst. What are you, assistant director? Associate director.
Associate director,
There you go.
a quant, a forensic accountant with HKA.
There you go. And she works primarily in their crypto units and working with a lot of startups. In her copious free time, she's also an adjunct professor of accounting at the University of Maryland, making sure the kids learn this stuff correctly. And she also continues researching all things related to this digital world. So she, just like my friend Dorothy, whom you all have met previously, can continue doing what they do to make us all smarter. So what's notable about Stacey is she also co-authored the National Institute of Standards and Technologies study, or the NIST study, that actually gave birth to the current encryption method, which if y'all wanted to, I'm sure she could talk about that, but that's for a different session. With translation being, she is super smart and we're lucky to have her. This is all interesting, but Stacey, why do we care about this stuff?
A lot of people are talking about tokenization, and you might have heard the term Web3 a lot.
Yeah.
Web3 means internet that incorporates blockchain and digital assets in some fashion. We're definitely moving that direction towards having more digital lives, towards having more of our business and our operations and our government transactions and all sorts of things that will be, as they call it, on-chain, which means to be using a blockchain to record transactions or to make property transfers, to hold value, to realize appreciation of value or wealth. So it's certainly coming up in spite of 2022's crypto winter, as it's called. We're moving in the direction of regulation. The FASB has now put out an exposure draft on how to account for fungible crypto assets, not what we're talking about tomorrow or today, but that's definitely progress. And it also shows that the powers that be have accepted, like, this is here to stay. So a lot of valuation analysts have encountered NFTs, and either, in my experience, where we've seen NFTs a few times in some of our cases that we've handled with HKA, very often both parties kind of decide, well, it's not really core to the issue, so we're going to try to ignore that piece, mostly because a lot of people, they get a little intimidated. They don't quite understand what it is or how to value it. It's a little bit of a weird asset. What I'm hoping to do with the webinar, and we'll talk about it a little bit today, is once you understand, I created this taxonomy, right? And it's like, once you understand four types, the types of NFTs, it makes it so much easier to then take all of the valuation knowledge you already have and just plug it right in, because then you understand, oh, this is the kind of NFT I'm dealing with, right? And so then I'm going to make these considerations for it.
Now, I think, if I'm not, correct me on this, I think Dorothy spoke about the fungible crypto assets, but she may have focused exclusively on the private issuer.
Yeah, she was fully focused on, she's going to be talking to you when you're talking about like crypto tracing and criminal investigations and the IRS and all this, and DOJ or FBI tracing crypto and all that. They are entirely looking at private issuer, fully decentralized.
Okay. So
and they're looking at those categories and coins that fall in that. All the markets that you see, vast majority of them, like if you go to like Coinbase.com or Crypto Market Cap or CoinGecko or wherever you want to go, you're going to see private issuer and fully decentralized coins. That's what's on there.
Okay. That's what I thought. So we have to come back to you later to talk about the CBDC and the DeFi instruments. We'll do that another time.
But if you go back to the last slide, on the last slide, I kind of skipped over it, but that enforceable legal rights piece. So I recently was able to get my hands on the Yuga Labs filings in California. They filed a lawsuit last June. So there was Bored Ape Yacht Club. Some people have heard of it. Some of you are going to say, I don't know what that is. It's a big collection of 10,000 NFTs, very, very popular. It's profile pictures that are apes with various background colors, expressions, maybe wearing a hat, not wearing a hat. All of these little characteristics and differences like make a big difference in the value or the desirability of a bored ape, right? So in and I want to say it was 2021 or so, but there was a guy named Riley Rips, and he basically said, I'm going to make like basically an entire collection that's copies of the Bored Apes or satire. And in some cases, it's exact copies of them, and I'm going to sell them and profit from them. So Yuga Labs, that created the Bored Apes, they've filed suit against him. And last week there was I want to say it's last week or maybe it was a couple weeks ago, there was a partial summary judgment by the judge in their favor, saying that yes, the NFTs are going to be protected under the Lanham Act. Now, I haven't gone through all the documents yet, but what I have learned and what I have been able to review is that you can file a trademark for NFTs. They can be treated as trademarkable, copyrightable goods that can become your business mark or some kind of designation, and it will be enforceable under the law. So you can go after anyone who, for a long time when NFTs first came out, people were like, oh, it's just an internet picture. I'll just, screen snip and copy, and what are you going to do about it, right? And now we can see, oh, well, you can't actually do something about it. So I think that this case in particular is laying out the groundwork for any creator who wants to make an NFT collection, or any company. Like, here's the path. You go trademark it, and then you can enforce the use, and you can, go after anyone who tries to rip off this trademark.
Okay. There's other litigation as well. There's something coming that Sony just filed, I believe.
So Sony just filed for a patent on
okay.
a method to transfer NFTs across games and across platforms. That's huge. Okay. So I don't know if we have any people who've done computer gaming. I game a little bit, right? Or maybe your kids game, right? And if they do console or desktop gaming, there have been conversations about, like, let's say, there's a thing called Twitch, right? Where a lot of gamers, they stream live while they're gaming. Let's say, and here's just conceptually, I want to give you like the conceptual idea of why this could be a big deal for some people. You have your favorite gamer. They play with one particular character, they level them up, and they win certain things, and they get to a certain level. With this patent, it has been speculated that you can then take that character, put it on a marketplace, and sell it. That makes gaming something where all those hours you put into playing a character and streaming and on and so forth, like, now you can actually treat that as some kind of a good that you're creating that's then, can be marketed. That opens a whole new place of metaverse activity and economics and gaming activity, or being able to like level up a character over here, and then, instead of having to start at, the bottom on another game, you can just bring your character over to the new game. So the whole concept of building something in game and then being able to sell it to someone else already happens with things like Minecraft. It's very popular. It's been popular for decades. This is now a method of integrating blockchain and NFTs as a method of being able to demonstrate ownership and transfer ownership.
And when you say the character, are you talking about what they call the avatar?
Yeah, if you want to call it the avatar.
Okay.
Yeah.
Just wanted to, non-gamer, I admit it. Okay, so I think that's about it. My mind is still blown by that, but that's okay. Now blow everybody's mind and talk about why Beeple matters.
Beeple is a very famous NFT artist. He creates these satire and kind of humor or mockery type NFTs, and he often creates physical artwork that goes along with it. So this particular NFT, it used to be the most expensive NFT that had ever sold. I think that record has been beaten now. I'm not sure if it was a Bored Ape or it was another one, but something sold for over 500 million. But Beeple sold this at the time when he sold the first 5,000 days, it went for $69 million, which was wild to everybody. Like, oh my gosh, like, wow, these NFTs could be really valuable. He was on podcast saying that he was raking in, $100 million a year just from selling these NFTs. What he did with this one is he combines, he makes an NFT every single day.
Wow.
That's his claim to fame. He makes a new one every day and puts it out there. So for 5,000 days straight, which how many years is that? Cheryl, you're a nerd. Can you tell me how many years is that?
I'm a nerd. You're going to prove in a minute why you're the nerd. But anyway.
So
It's a
this
lot of
is where
days.
he took, I don't know if it was 5,000 days worth. It doesn't look like there's 5,000 images on there, but he took all of the images he had created day after day and he put them into one image and sold it.
It's 13, almost 14 years. 5,000 days. I just did
So
the
it
math.
couldn't have been that because NFTs have only been around since 2014. I
Right.
think it was probably closer to 500 days, but
That's-
yeah, that's the claim to fame with this particular one, and this is a very famous NFT. So it would still be probably very valuable. You'd have to find it online wherever it is, and I'm sure that it, it's still multi-million-dollar valuation.
What's two other points on this? One is I think this image itself and the sale are what provoked a SNL skit, which we actually have a link to at the end of our materials here. It's kind of cute and explains NFT in a really down-to-earth way. So the other point that I wanted to bring out here is that if that image was a Rorschach inkblot test, I'd be seeing it and saying, okay, it's a new piece of visual art and happens to be the most expensive NFT ever as of, 2 weeks ago or what have you. But in reality, Stacey's going to explain to us that it's really not that. Why don't you tell us why it's really not a bunch of pictures?
So the images are cool, obviously, and that's what drives people buying and selling them. But just to talk about, well, what is an NFT? The NFT itself is the hash string that is generated from that image's metadata. And
Okay.
you essentially are using cryptography and cryptography techniques in order to record transactions on a blockchain. And what you do is you take the hash string that represents the NFT or the metadata that represents it, and you're essentially associating that in a transaction with someone's crypto wallet so that you can say that, and that's what makes like ownership happen. So tomorrow in the webinar, we're going to look at some of the Etherscan records, and I'm going to walk through what they look like and how you can see who owns it and what are the important transaction hashes or what are the other important hashes or information that you want to pull off of an Etherscan record.
Okay. And I have no idea what any of that just meant. So I'm looking forward to learning more.
The big thing that people should take away from all of it is that hashes are like digital fingerprints.
Okay.
And we'll try to talk about it more in the webinar tomorrow, but making a hash algorithm is a type of cryptography. It makes a unique string of numbers and letters that acts like a little fingerprint, right? So if let's say I had an NFT and I use its metadata to generate, and metadata meaning like the date it was created, the background color, what's it of, other characteristics on it, that's used as the metadata.
Right.
You generate that hash string. If I change the background color, if I change one character in the metadata that I've input for that NFT, it will change the hash.
Because the
So
hash
then
is.
if someone were to change the metadata and then try to give me that NFT or that image and say, well, this is an authentic item, I can take that item they give me, take the metadata that would be inputs to the hash, re-input it, recalculate it. If I don't get a matching hash, then I don't have an authentic NFT, right? So hashes are used for like validation and authentication. Is this data authentic? Has it been tampered with? And hashes are used, like, for instance, in emails. There were early use of hashing in the internet was generating hashes to prove that an email had not been tampered with.
Okay.
Before you had end-to-end encryption or any kind of encryption on email.
Okay. And it's more unique than, say, a DNA strand. Is that accurate?
have heard that it's far more unique than, I don't know about DNA, but it is more unique than a fingerprint. Like the chances of a false positive with fingerprints is like 1 in 300 or something. And the chance of a false positive using the SHA-256 is like 1 in a quadrillion million or something.
Wow.
Yeah.
Okay. Well, I'm just going to keep moving that thing around because I'm not allowed to take it down. So we have, come on, folks, finish this poll. So we have Stacey created the taxonomy we saw previously. She also has this very neat, and I'm going to push this guy out of my way, this very interesting visual on how to create an NFT. I'll just have to move this guy back and forth.
So this is a visual that was in the Journal of Accountancy article that it walked through the 4 types of NFTs from last October.
Right.
And this is just trying to give people a simple idea of, here's how, if you are a creator and you want to make NFTs, this is at a high level, this is what you do. You need a crypto wallet and you need to add some kind of crypto asset. When I say crypto asset, colloquially, that's what we would call cryptocurrency.
Okay.
But in accounting context, we try to avoid saying currency because
right. Technical.
because it's not
definition.
currency. Technically, under the law, it's not currency,
Right.
but it is an asset. So when I say create a crypto wallet and add crypto asset, that could be like add Ethereum, and I've got the Ethereum logo on that wallet there.
Right.
Then
But
you go to like a website like say OpenSea, and you would upload the file that you have created with the image that you've generated.
Okay.
Now this is like someone who's creating the NFTs offline. The other option for creating NFTs, which I didn't put in here just to keep it simple, you can use a smart contract. You can have a smart contract that has a crypto wallet attached to it. You can have that smart contract generate the NFTs. But they're all kind of doing the same thing. You have to link to a marketplace, and then you have to upload your images or get those images into the marketplace. And then you submit those images and you pay a gas fee to the blockchain network to process that transaction. And what they're doing is they are processing the transaction. They're creating a blockchain record that associates that NFT and its hash to your wallet address. That's what they're doing initially.
Okay. And then that's really not that different from when you would buy, say, software online 100 years ago, and it said, this is the code you have to enter. This is the registration number. It's the way that you track what you're doing. Is that right?
That's not really how I would describe it, but
okay.
Yeah.
Okay. All right. So
it's more like a deed of ownership in some ways.
Okay.
Like when you buy a house, or like a car, and you have to transfer the deed, right? It doesn't matter who physically has the car. Whoever has the deed is the owner.
Okay. All right. All right. So back to your taxonomy, the stuff where you focus, where you find your passion is in this NFT area. Do you want to just take us through what we're looking at here?
So I created this taxonomy because I was having challenges with teaching this stuff to accounting students, because I kept trying to say, well, here's your guidelines for this group of assets, or this is how you're going to treat it. And there would always be like, oh, well, but what about this kind of thing? Or what about that kind of thing? And I needed a systematic but simple way of breaking down, here's your universe of stuff. Here's how you're going to classify them for accounting purposes. So we don't all go insane and people will stop arguing with me when I'm trying to give you guidelines. And so I came up with this, which at this point, this has been published in the Journal of Accountancy. I'm currently working with the editors to publish the full taxonomy soon. It's gone through technical review with multiple people in their digital asset working group. I've put it in front of crypto CFOs community. I've put it in front of the Government Blockchain Association group. So a lot of people have looked at this, challenged it, critiqued it, and the NFT piece has held up and remained basically unchanged since we first put it together. So types of NFTs, authentication NFTs. This is where people say, oh, we're using a blockchain for supply chain stuff, or we're putting it on blockchain, but no crypto is involved. So there are some use cases, and there's certainly startups. I've worked with a startup in Africa that's doing this for food exports, and they're basically just using the concept of hashing in NFTs. They might not call it an NFT, but they're using the same underlying technology of like basically creating a hash that's then associated with a good, and then it transfers ownership through things. And that's authentication NFTs. Crypto usually isn't involved. With an authentication NFT, the valuation is usually in dollars. And that's kind of a giveaway. If someone says, well, we're using blockchain, and you say, what do you have on the blockchain? And they say, well, you know, we're tracking lettuce, and it's $3 per head of lettuce, right? Then you're like, all right, this is an authentication NFT. I don't really need to worry about any of this, you know, techie stuff. I can just, you know, use this blockchain record as a source of information about these goods, right? Ownership NFT are the things that we're focused on for the purpose of the webinar. And these are NFTs that are used to demonstrate ownership. They are always valued in some kind of crypto asset, most commonly in Ethereum. Ethereum has like, I want to say 96, 97% of all NFTs, it might even be higher, are minted and traded on the Ethereum blockchain.
When you value them, I'm assuming that we're going to be converting at some point, and this might be getting ahead of myself, so just tell me if it is. When I value them using Ethereum or whatever other currency, am I going to have to treat it then as if it's some sort of a foreign currency, for lack of a better term? The value at this date, this is what I purchased it for, you know, get the per dollar value just to get to a stable currency, do all my math, my gyrations, and then retranslate it back to Ethereum? Or would I just leave it in Ethereum because my financial statement, or I'm sorry, leave it in dollars because my financial statements are in dollars, presumably?
On NFT markets, everything will have a dollar value in addition to having a crypto asset value.
Okay.
So they've made that easy because, you know, the IRS requires that you track basis in dollars, and a lot of tax authorities require you need to track it. They provide it in dollars. If you're not, you know, if your native currency isn't dollars, then that's a little more of a challenge there. Depending on the NFT, depending on its sales history, that dollar value that you see on a market may or may not be reliable. But you're going to have dollars throughout, even on the blockchain explorers where you can look at the past transactions. It usually translates it into dollars. And what's really nice about Etherscan in particular is if you go and look at, if you hover over those records, and we'll walk through this in the webinar, you can hover over the amount and it'll show you what the amount was in dollars at a prior date, which is great because it's automatically taking into account the exchange rate change in valuation in dollars. Perfect.
All right. So some of this you already covered, and Chinda, I am going to run over by probably a few minutes, so don't be too angry with me. But it's really important that we get through this stuff. So when you're creating the NFT, I think you already talked about the regulation piece as far as protecting your intellectual property. Anything else on that you want to add before we jump into the valuation section?
I think we've pretty much talked about all the highlights on that aspect.
And I just want to point out to everyone that we do have
you can make this an NFT.
Okay, well, get on it, sister. Now let's talk about the accounting for the NFTs, the accounting piece that leads to the valuation. So we have an NFT, it's protected by copyright, and we're going to account for it properly because, you know, it's becoming more normalized. So digital assets are still assets, right? And we know that, that's the gimme, that's my part, that's the easy stuff. We got to worry about accounting for all this other stuff. Stacey, you want to talk more about this, or do you want to just jump into the higher level where we're still waiting for guidance?
So we don't have any guidance on how to account for NFTs. There is no accounting guidance. One thing that I need to say here, and I'll say it again in the webinars and any training I give for you guys, any opinions I express on how to account for NFTs is my opinion. It's not authoritative. There is no guidance on how to account for NFTs, right? Now,
Right.
if you look at, for instance, this particular image, it's funny, don't be this guy, do your accounting. And it has Cryptio. Cryptio is a well-known crypto subledger accounting software plugin where you can plug in all your wallets and it'll, basically give you all of the accounting and the general ledger style entries so you can track your crypto activity.
Right.
Great software. However, they advertise having an NFT module, and they say that they are GAAP compliant and it is fair value accounting. You can't be GAAP compliant if there's no GAAP standard for it. Okay, we don't have a definition from the FASB about this. And I think Cryptio is a great software. Amber is a wonderful woman. I've met her in person, absolutely love her. She also has a great passion for nerdy accounting shirts as me.
Cool.
What's more is, in my opinion, and I'll lay this out, maybe I'll have some more time to lay it out in the webinar tomorrow. I do not think that most NFTs need to be accounted for with fair value accounting. The vast majority of them, reusables, perpetuals, some real assets, reusables and perpetuals, for the most part, these are indefinite lived intangible assets, in my opinion. And that's that's different accounting from fair value. So nodes and blocks, not so relevant for accounting necessarily. Mining isn't relevant to NFTs. Mining is a crypto asset activity. Minting is relevant. Minting is the creation of NFTs. DeFi, you might be using NFTs in DeFi activities, staking, in liquidity pools. DeFi can get really complex. You can get into derivatives and synthetics and all sorts of crazy stuff. Gas fees is an important consideration. A gas fee will always be an expense, and you need to take the gas fee into account. When you're talking about, for instance, let's say a bankruptcy, you have to transfer the NFTs, right? There's going to be a gas fee associated with that. You actually want to reduce the number of transfers you have, because the more transfers you do, the more gas fees you're going to rack up. Now, gas fees used to be quite expensive. Now they're down to around $5 or $6 on average. They're averaging under $10 per NFT. Gains and losses, that matters if you're doing fair value accounting. FASB has indicated they're moving to fair value accounting for crypto assets. Again, someone says, what's a gas fee? Gas fee is like the fee to record it on the blockchain. The blockchain is decentralized. It's run by all of these different computers. And the way they're incentivized on the Ethereum blockchain is you pay a transaction fee. Transaction fee is a good word for it, but it's called gas. So you're paying for gas.
There you go. All right. I think we already spoke about some of these unknowns at this point. Anything else you want to add here about the fact that everyone is still, evolving with their guidelines for the different reasons and purposes behind accounting?
So I know AICPA is their digital asset working group is working on some guidance for NFT accounting. I haven't seen any drafts. I haven't heard from them. They're kind of keeping it under wraps. We'll see what happens. We'll see what happens with that. The AICPA, the most recent guide, they in the back, they include some excerpts from the SEC staff accounting bulletin 121, I want to say. Okay. And all of that, the only thing that they're saying in that bulletin when they mention NFTs is that when we talk about crypto assets, we're including NFTs. It's essentially the SEC saying an NFT could be a security. Okay. And IRS treat it like property. At this point in time, until we have other guidance, all digital assets with the IRS are treated like property. And then PCAOB, they don't have anything specific. They just said, we're targeting that for this coming year. I think that you'll get something specific after FASB issues their final standard. Right. It's kind of, they're holding everybody up. Now let's talk about the fun part, accounting for them from the record keeping side. And you're going to focus on this a lot tomorrow. Is that true? Yeah, so we're going to spend some time looking at that. I mean, here's the deal. If you have a lot of NFTs, or if the business has a lot of NFTs, you either want to get them to use a crypto subledger software. There's lots of choices out there. If they have a lot of transactions, like use a crypto subledger software, because it just greatly simplifies things. If you have a client who says, oh, well, I have, 20 wallets across these different platforms and well over 1,000 transactions, and you're like, where do I start? One place to start potentially is using something like my favorite that I used for my own taxes was Crypto Tax Calculator, where you plug in all your wallets and then it basically takes all of your transactions and it will calculate the tax gain or loss, right?
Wow.
While that's for tax purposes, you still get all of the transactions in a little more of an organized, orderly fashion. It can help you to sift out the between wallets transactions. So you're not looking at, you don't get that mixed into it, and you're really can focus on transactions that go between them and a third party. In early days of NFTs, I don't know to the extent to which it happens now, but there was some accusations. I actually have never seen a specific example. I've just heard people say that there was transfers of NFTs back and forth to pump up their value, and it was transfers between wallets the same person owned. So they just transfer it back and forth to make it look like, oh, there's tons of sales history. And look at that, the value's going up. And they were just recycling their own money.
Okay. So we'll deal with that tomorrow. Now, for the most important part for some people, right? Just like the accounting for the digital asset end is getting more and more nuanced, so is the valuation of these things. Now, big, super high level picture, you've got the same stuff that you look at for any other valuation. You've got your subject interest, you've got premise of value, standard of value, and you've got, the key items that you want to reference to. But I think most importantly, just as a reminder for everybody, we've also got to remember that there's no explicit guidance yet. So what do is you go back to the fundamentals, you go back to your beginning, you look at your professional standards and say, how should I treat this? Y'all just heard me, Stacey and I, talking about, well, GAAP would or wouldn't consider this to be currency, so therefore it's got to be a digital asset, not digital currency. So you go back to the foundations of valuation, look at the reference documents, and then, put together your valuation analysis. So what does that look like? What's that?
I think that tomorrow's webinar, where we go in depth and go on a deep dive of the 4 types of NFTs and talk about the characteristics of each, that definitely helps guide things. Once you kind of have an idea of, all right, I'm dealing with a perpetual NFT, and it's being used to set up a virtual office, and they have started generating X dollars of revenue with plans to generate this much more revenue. Let's say you're in a lost profits case, right? Where they say, well, because of X event, but for this, right, I could have made so much, right? So, and you have a perpetual NFT that's a location in the metaverse. And you have to value that perpetual NFT. Well, in that case, I mean, once you understand what's going on, then you just apply all of the valuation principles you already have, and you build your valuation model, right? It's just a matter of kind of making sure that whatever assumptions you apply are appropriate for that type of NFT.
And what we did here is this is in the materials that were passed out. I just got a note. We're going to get the hook in a couple minutes. So, some of the main questions that I culled from Stacey's brain are here for you. How does the NFT impact the company in terms of its value? That's really what you're looking at here. Anything to add here before I flip along to the next?
This is a great slide for just kind of walking through some of the high level considerations, like how was it created? What was the purpose of creating it? What is the history of transactions? You might be considering what is the current market conditions of the crypto market? Is there still a market for this NFT? If the NFT is attached to a collection, are there other benefits or perks that are happening outside of that collection? If you're doing evaluation for the business that owns the NFTs, is NFT creation sorry, I saw the chat note there to wrap it up. So
now you're getting in trouble. Anyway, so yeah, there's a lot to consider. Stacey's gonna be all over that at tomorrow's webinar. Just again, reiterating financial position, where's this thing on the balance sheet? Historical operating results with it, and and projected in the future.
Right.
I think it's going to be interesting though to see where the companies are in the future when you look at guideline transactions of the companies that own them, and then transactions within NFT owned by these companies.
Yeah, there's a lot of development to happen, and it's going to be an exciting future to see where we go. But I think tokenization of assets and blockchains and NFTs are a fundamental part of Web3, and it's going to be a part of our future.
And because we ran over doesn't mean that that's all there is to it. So there's this webinar tomorrow that we can all crash NACVA's website and register for now. We've also got some articles for you here in the materials, including Stacey's article from, I guess, last year, maybe 6 months ago. NACVA's had a few publications on it and some additional resources. This is the practice aid AICPA just put out. You'll see
and the most important link, SNL.
Yes. Don't let me forget that. We almost got in trouble. We were going to put the link for the SNL skit in the webinar, and we were reprimanded and told we can't do that. I was going to blame her. But anyway, so the link is there, as are the notice 2327, which just came out. And a couple of years back, we had, tax treatment for transactions. It's property. And as Stacey said, the GBA that she's involved with, she's going to be speaking for them. When are you speaking for them? May 24th, 25th, there's a conference event that they're hosting. I think you're speaking there, aren't you?
Yeah, I'm doing a fireside chat with Marcus Veith. He heads up Grant Thornton's blockchain and crypto group. So we're going to sit down and talk about FASB's new standard and where we are with accounting for it. But we're going to be talking about fungible crypto assets. We're not going to cover NFTs. So tomorrow's all about NFTs.
So you're going to talk about the fungi.
Yeah, you could. I guess you could say that.
I told you I was going to get that in. All right, my friend. That is all that we have. Thank you so much for doing this for us. If you want to get hold of Stacey, I think I just lost my slide. There you go. They took back control. And that's it.
All right. Thanks, Cheryl. I appreciate and thanks to all the NACVA hosts and organizers. I appreciate you guys inviting me on.
Yeah, thank you, Stacey, and thank you, Cheryl, for doing that. Just want to make a quick note, as they mentioned earlier, there is a webinar tomorrow on this topic to elaborate on it from 1 to 3 Mountain Time. You can receive, actually, for attending this session, you are eligible for a 20% off your registration discount if you use that promo code. In red, it's ABW in depth. And yeah, thanks again. And also, I just want to do a quick mention about our 2023 Business Valuation and Financial Litigation Super Conference is coming up in July and also in December. The July one will be in Snowbird. In December will be in Fort Lauderdale. You are eligible for a $250 discount, $250, discount if you register and pay by March 31st. And in your material, there are links for registration information. And if you click on that, you'll get some information about the agenda and the lineup of the presenters that will be joining us. And with that, I'm going to turn the time over to Alina, who will get us started with the judges.
Thank you, Shanda, for all that information. And now, just to not take more time, we're going to have Alan Zipp. He's going to be talking today to the judges, and they are going to be talking about how can experts help judges understand business valuation principles. Alan, you're muted.
Okay.
There you are.
I'm sorry. I was thanking you for the introduction. What the issue today is very, very complex. And let me see if I can do this correctly. I'm going to try. I'm technologically in advance. In any event, the question I'm posing to the judges is how can we as experts help you as judges understand our business valuation principles. And I put together a number of questions that spur discussion. So let me just, we have Judge Platt with us, and I think Judge Driscoll's not with us.
Judge Yates just sent something asking for the link because he couldn't find it. So
Yeah.
Yes, I already
I'm
sent
on-
it to him. Mhm.
I'm on, but my video's disabled.
Can we fix that? Because we would love
Yes.
to see Judge Yates with it. Okay, so we have got really a good opportunity here. So let me just go ahead and kick off the questions. And here we go. The first one deals with the concept of the nature of our engagements. We have valuation engagements under our standards. We also have calculation engagements. Now, the premise is that valuation engagements require more procedures than does the calculation engagement. The question for discussion is, how can we, as an expert, explain the differences to the court and maintain credibility for the value developed by the appraiser when we use the calculation engagement? Go for it, Judge Platt, please.
by process of elimination, right? At least for the moment. I would caveat with my answer, but up front by saying it matters when you're trying to make that explanation, whether it's in the context of testimony in a courtroom or whether you're presenting a program to judges as NACVA is to, for instance, to the American College of Business Court judges. As I have said, I've done a lot of educating of judges, and that's who we're talking about. And they're not the most patient audience in the world. That needs to be factored into the presentation. If in fact you are talking to in a case and you're on the witness stand, you have to have prepared your counsel to ask you the questions, because you're not going to be allowed to give a presentation or a speech in the context of your testimony unless you're asked a question that precipitates it and it's not objected to. So the bottom line, if you're on the stand and a witness, is the right questions to be asked. Secondly, if you're presenting a program, you've got a little bit more latitude, but even there, as I have suggested to not so much to your experts, but to academics, don't teach this like you do students. Again, you don't have a patient audience, and there are probably a number of egomaniacs in the audience who think they already know. Bottom line, again, this time, if you can put it in your explanation in the context of their own experience, which is listening to cases where there are very specific fact patterns, take one that is illustrative of your point that you want to make and put it and do the explanation in that context.
Judge H, would you comment on the trial presentation? Is there any way that we as an expert can blurt it out, if you will? If we can't educate our own retaining counsel, how can we voluntarily get it in there or not? I mean, if we can't do it, we can't do it.
Well, I'll offer this suggestion. It certainly is the case that if it's a bench trial, the judge will give you some latitude if you want to try to insert it yourself. In front of a jury, though, it's harder because ordinarily the explanation has to come in response to a direct question or something on cross-examination. Obviously, if you get a question that affords you the opportunity to offer what you want to say, feel free to expand on that. But in the absence of a question posed to you, you're always taking a bit of a risk by trying to insert what you want to say. But if that's the only way to get it in, then that's what you have to do.
Thank you. Let me move to this analysis that we're going to talk about, quantitative. Quantitative uses subjective judgment to analyze a company's value based on non-quantifiable information. such as management expertise, industry cycles, strength of research and development, labor relations. How can the expert help the court understand the importance of analyzing the nature of business and the history of the enterprise, the economic outlook in general, the condition and outlook of the industry in particular? These are qualitative that we analyze. Can you help us understand how we can present this to you to help you understand it?
From the perspective of a judge who's the finder of fact, intuitively, I understand that good management, for example, is something that enhances the value of an enterprise. But for a jury, that may be entirely foreign to them. And so you might want to try to rely on some sort of analogy that they'll more readily understand. For example, the value of a really good football coach to the team, or the value of a really good manager to a baseball team, or somebody who is just especially skilled at getting people to work together. For a lot of the jurors, unfortunately, the whole concept of non-quantifiable enhancers of value is just not something that they readily understand. And so you want to think about it in advance of your presentation and think about what you want to analogize it to that you'll think will be more readily acceptable and understandable to them.
And I would just add to that I noticed the topic is how can experts help judges? And we'll use judges in the widest possible terms. If you're talking to an American College of Business Court judge who's fed and who's gotten training and who is not going to have as great a difficulty as Judge Yates just described that a jury would have, and may not even have as much difficulty as a judge who's not trained, who hasn't had these kinds of cases and who hasn't even thought about these kinds of subjects. But if you've got an American College of Business Court judge who has got training, you may have difficulty if you have a particular technique that you're using for these non-quantifiable, the value of them and the weight to be given and why you're using and giving them the weight that you are. You're going to have some judges who are trained who are going to think they know as much as you do, and you're going to have to convince them that they don't, in order to accept what you're doing if it's different than what they have opinions they previously formed. They probably had cases where this came up, and they've heard various explanations. A jury, for the reasons Judge Yates just described, probably hasn't. And then you're into the world that I live in. You have an arbitrator, could be one of your own, could be somebody who's worked with the experts in this area before, who has opinions, who's heard other opinions. That's a different ball game completely. So know your target, who it is you're trying to convince. That's generally true of everything we do, but it's particularly true in the context of litigation and arbitration. And even mediation, if you were an expert there, you might be trying to convince the other. I use the term judge about as broadly and probably more broadly than it was intended. But again, if whoever it is that's going to influence the decision, and you want them to come around to your evaluation technique, live in their world.
Judge Yates just made a majorly important point, because I just came out of a trial last week in Virginia. And here's my question: is some judges focus on numbers to the exclusion of the non-financial information, which is important to the analysis of the business value. How can we as an expert help the court understand the importance of non-financial information, including the management, the products, the key services, key customers, suppliers, competition, business risk? If you could elaborate a little bit on how we can help steer the court into that direction, I'd love to hear it.
What I always try to tell people is that there's a tendency in business or corporate governance or government or anywhere to measure only that which is readily quantifiable. And that's a mistake, because you're missing a big part of it. For example, if you're in front of a judge and you're trying to explain this, you could say that it would be defective to weigh judges simply on how fast they move cases and what their reversal rate is. There are all sorts of softer sides of being a really good judge that can't be quantified. How polite are you? How well do you manage settlement conferences? Things like that. And that's something I think a judge would readily understand. And then for jurors, if you're explaining it, one of the analogies I draw is parenting, for example. I mean, there are some aspects of parenting that are quantifiable, I guess, whether your children go on and graduate high school and go to college and so on. But really, are you measuring the effectiveness of a parent if you're limiting yourself to only those things that are quantifiable?
You may also want to try to break through. Some judges look at you or an expert in particularly if they're not trained beyond this, that they're assuming you're CPAs and the only thing you care about and more importantly know about are numbers and quantifiable products. You may need to convince them that you do know something about the non-quantifiable factors more than they do, and that what you have to say and your evaluation technique is important. And it doesn't need to be just based on that, and it doesn't need to be just based on quantifiable terms simply because you're a CPA or whatever you are. They are assuming that you're a CPA, if that's what you are, and that's what's important. That's what you know about. And to the extent you're relying on anything other than that, they initially have to be convinced that you're not doing that because you don't know enough about the quantifiable part.
Yeah, but the quantifiable analysis uses the historical numerical data and statistical methods. I mean, we do this, and we do it to evaluate the past financial performance of a company to understand its financial health. That's what it does. But we would need to help you understand that, and I don't know how to do this other than in response to a question, but that's always the answer to the how do we get it in. I'd like to figure out a way we can get it into testimony without a direct question. But the focus of quantitative analysis really is in the developing a basis for projecting future economic benefits and assessing the risk of not achieving those economic benefits. So help us understand how we can help you ask us the right questions if we can get you to ask us questions.
You can, I will jump at it and then let Judge Yates develop what he said earlier, because that's my answer. To get to the right questions and the likelihood of you being interrupted or not allowed to present what the information you just described is much less if you're asked the right questions. If you're trying to get it in despite that, which means training your retaining counsel.
Well, that's a question I'll ask you later.
Don't assume they know what. Don't assume they think that's as important as you do.
Right. I would say this about your responses on direct examination. In all likelihood, your retaining counsel is not going to cut you off. And so the only thing you have to worry about is an objection from opposing counsel that you're not answering the question that was asked. And I think they're going to be unlikely to do that if you only filibuster a couple of times. In other words, every expert's given a fair bit of latitude. And unless you abuse the privilege, generally everybody will let you finish an answer as long as the answer bears some relation to the question that was asked. It can be quite attenuated, but as long as it bears some relationship, that should be fine.
Excellent. That's outstanding. And if just to elaborate, as a testifying expert, we do have some latitude, don't we? As an expert, we can answer a question that wasn't asked, but resembles something that was asked to get our information in.
Right.
That's great. I'm going to move another one for you. Normalizing adjustments. This confuses a lot of judges, but we're making changes to the historic financial reports, and they often need to be adjusted. When we do our analyses, we find extraordinary or non-recurring and non-operating items, and we're trying to develop an economic picture of the company. And we need to help the court understand that there is a need to adjust tax returns and financial statements to determine a normalized economic earning capacity from which a business value can be developed. Can you discuss that a little bit on how you perceive these adjustments?
Yeah, I would say 5 years ago, this would have been something that would not have been a concept that anybody readily would have understood. But at least for the foreseeable future, you have the benefit of analogizing everything to the COVID pandemic, where business operations were interrupted to such an extent by external forces that it's hard to draw any conclusions from the way in which the government operated, the way in which private enterprise operated, the way in which anything operated for some substantial period of time. And so if you think about normalizing, what you're thinking about is trying to look through or look past whatever that precipitating event is and try to understand what an ordinary flow of the business operations would look like unhindered by something like that external force.
Judge Platt,
Nothing that would enhance that explanation.
thank you. I mean, you guys, this is wonderful. The standard of value question comes up. There are a number of different standards of value. An example is fair market value, fair value, intrinsic value, investment value, divorce value, et cetera, et cetera. And each of these standards may result in a different business value. And the courts frequently do not understand the differences. How can we help? The reason, for example, in the instant case, why are we using a particular standard? And I have seen in Virginia, for example, uses an intrinsic value standard in divorce, and Maryland, where I practice also, uses fair market value, and they're different. Can you comment, please, on how we can help explain this?
I'll double down on what you just said. Explain it before you give your opinion. Explain why you're giving it. Again, the question is extremely important, and the opinion that you're offering is that, and the answer can be there are several different standards. This is a such and such a case. This is a case in which the fair market value is what you're asking for. You're not asking for the divorce value. You're not asking for and explain that. If the judge doesn't understand it, it's because he or she's never heard of it. And if they have heard of it, then you may have some preconceived notions you need to deal with. But deal with them and explain why, maybe before you offer the opinion. The other thing I would say, just because of the world that is watch out for these agreements that require a specific type of value, even though they don't make any sense in the context of what's going on. Poorly drafted agreements, and I've had a number, not just a lot, where the agreement required a certain value to be reached in a certain way. Once you've contracted to do that, then you've in effect contracted to get the wrong answer to the question that's being asked, and you've got to overcome the fact that the arbitrator, judge, not jury so much, but a jury or a judge is sitting there looking at a contract going, that's not what this says to do.
Should we simply assume that the proper standard should be applied, notwithstanding a contract, or should we, as experts, apply the contract?
At your peril, you do the former. Because if you're going to do that, you better talk with retaining counsel and whoever else you need to talk to, because if the fact finder, be it a judge or an arbitrator or whatever, sees that that's what you're doing, you may have the whole thing, you may have your opinion completely rejected or not even allowed, if he or she perceives that what you're doing is offering something that the contract says is not what we're looking for. And the judge, if the judge renders an opinion and says, I'm rendering an opinion notwithstanding the valuation technique prescribed in the contract because it's the right thing to do, there will be very few appellate court judges who will understand why you did that, except maybe Judge Yates. But you can't just do that without a very thorough, and frankly, I can't think of what the explanation would be in the first instance. And an arbitrator has a whole lot more latitude to do that than a judge, than a trial judge, or even an appellate court judge, because the parties entered into a contract, unless there's some reason to say that the contract doesn't apply or is inapplicable or somehow can be thrown out, as you're treading on very thin ice by, in effect, adopting a technique that's different than the one prescribed in the words of the contract.
What I would say, and the attorneys who practice in front of me knew this about me, is that I always like to see several different computations under different standards of value, so I could get a sense of which one applied most readily and whether there was a particular outlier. That protects against what Judge Platt is describing, where you just launch off in your own standard of value analysis, not using one prescribed by the contract, for example. There's nothing wrong with putting several different standards of value in play and putting meat on the bones for each one of them. And I found that really persuasive if it was done right.
Thank you. That's excellent advice. We learned today that the tax court reluctantly accepted tax affecting in a case, which is not precedent, but tax affecting is the discounting of estimated future company earnings on the basis of assumed future tax burdens if the company was not a partnership or LLC or S corporation, which does not pay taxes. Now, how can we help as experts assist the court in understanding the differences in value when tax affecting is or is not applied, and then the differences of opinion among appraisers as to whether they should apply tax affecting?
To my mind, this is one of the great challenges of testifying as an expert, which requires you to be a bit of a teacher, because this is something that is not readily understandable, even for judges. There are lots of judges, I'm sure, who do not understand that there's a world of difference between the way a standard corporation is taxed and the way a partnership is taxed, for example. And as you have to remember that all of us judges just simply get paid salaries and we don't have to worry about these niceties. So unless you actually ran a corporation or had your own firm and had to think about it, the particular organizational structure you choose doesn't inherently seem to be something that would affect the valuation analysis, and yet it does. And so I would encourage you, particularly if you're going to try to make this point about the impact of tax affecting earnings, to take the time it takes to lay a little groundwork and explain how that matters.
Judge Platt, did you want to comment?
Other than to just again echo what was said in terms of the teaching, the challenge of teaching and the difficulty in doing that when you have somebody who's you're teaching, know who you're teaching, and they have no background at all. So you've got to get really basic, and you're not insulting them by doing that.
Yep.
If you don't do it, you run the risk of sailing over their head, and in a way that will be counterproductive. The other thing is, if you have these difficult concepts, and again, I'm not unbiased in this area, where you've got different valuation techniques that we've alluded to in the previous question, and now this, you may want to advise your retaining counsel and through him or her, their clients, that you've got a problem with valuation techniques that are one's called for in a contract and another one is the one that ought to be used and should have been called for. They may want to try to compromise the case and get closer to the right one, because they're going to have legal issues at a minimum getting to the to a number that makes any sense once the valuation is known and the right one is on the table.
Well, this issue on using case law, please give us the guidance that we need, because we as appraisers are regularly reading court decisions about valuation cases, including tax court, marital property and divorce, shareholder disputes, etc. Now, how should the expert use case law in making business valuations, and how can we as experts communicate to the court the basis of our application of the case law principles used in the instant case? I'd love to hear.
I think here your risk is exactly the opposite of your risk when you're dealing with tax affecting issues, because here, when you're relying on case law, you're essentially, I know you don't mean to do this, and it's perfectly appropriate to rely on case law, but you're daring the judge to play with tools that are really familiar to the judge. And so anytime you're going to rely on a case, you better be darn sure that you have the facts right, you have the holding right, and you have the implications for the case where you're testifying right. Because this is one of those where a judge can easily go in and disassemble your analysis of the case, viewing it as incorrect. So whereas with anything relating to tax affecting, the judge is likely just to sit back and listen. Just expect that anytime you rely on a case, particularly if you have a judge who does a lot of business court work, the judge is likely to engage readily and really question your reliance upon the case.
And for those reasons, you may have to undo some impressions that the judge has gotten over the years based on his or her experience with the case and or the statute for that matter. I mean, I remember the Marital Property Act has been used to justify all kinds of valuation techniques in all kinds of situations. And most judges, that even the one that forget about the business cases, if they heard a lot of marital cases, they've heard these arguments before. They've probably formed an opinion. It may or may not be right for this particular case or applicable to your opinion in the case before him. But you may have to not only just educate, you may have to undo some preconceived notions that are going to stand in the way of your evaluation and opinion being accepted.
A couple other questions, and then we turn it over to Michael Kaplan, who's got something to offer about using the judges. But how can the business valuation expert develop the skills needed to assist the court in understanding business valuation methods and principles so that problems arising from misunderstandings can be minimized or eliminated in the future?
This is a very fine line to walk, and I've seen really experienced experts do it well, and I've seen inexperienced experts do it badly, because you don't want to come across as too preachy or pedantic, but you nonetheless want to offer explanations that are helpful to the court or the jury in reaching the verdict in the case. And all I can tell you is when you're doing something like this, when you are trying to educate, you have to keep a good close eye on the audience, whether it's the trial judge in a bench trial or the jury in a jury trial, to make sure that you're not losing them. I spend a lot of time as a trial court judge just observing the jurors as experts were testifying, and you can usually see on their faces that they're confused or they're annoyed or they're fascinated. And if they're fascinated, keep going. And if they seem confused, you may want to stop and try to rephrase something you're explaining. And if they seem annoyed, it's probably time to stop and let your retaining counsel ask you another question.
And I would just emphasize what was just said by saying, I think one of the ways you do that is be careful and use very common sense examples of what you're talking about. The football coach, the value of a football coach was a very good example. Also, I know the focus is storytelling. Can be helpful, particularly if that generates the right examples. And lawyers call it framing, but that's what you're doing. You're framing the issue in a way that is convincing and allows you to persuade. I was just going to answer your question directly by saying the answer to the question is take Michael Kaplan's training.
Exactly.
Okay, we're gonna let him promote that in just a minute. Let me ask you about this. You've said it several times, is that we need our retaining attorney on direct examination to ask us the right questions. Can you give us some thoughts on how we can prepare and educate the retaining attorney about business valuation issues in order to make the testimony effective? Should we prepare questions for retaining counsel?
I wouldn't script the whole direct for them. That might seem a bit presumptuous, but I would certainly give retaining counsel some questions that you think need to be asked. In every trial I ever did, and I did a lot of them, I prepped with every single witness I could. And at the end of each prep session, I'd say, now, have I missed something that we need you to talk about that we have to make sure we get in there somehow? If you're not given that invitation in a prep session by retaining counsel, you need to essentially step into the lead role and say, you need to ask me the following 5 or 6 questions. I've listed them out.
Excellent. Judge Platt?
I couldn't agree more.
Okay. I want to give Michael Kaplan the remaining 5 minutes of our session for an announcement he has. Thanks, Mike.
Thank you, Alan. One thing that it's important that we all recognize is that my earliest experiences working with Judge Platt and Judge Yates was when we were teaching in a complex commercial cases curriculum at the National Judicial College. What do I take away from that? Judge Platt understands this stuff. Judge Yates understands this stuff. They both do, and Judge Driscoll also understand it better than most of the judges that we are going to encounter in our travels. I mean, they are committed to judges who sit in the business court and have the skill set to better understand the things that we're talking about. And that's very, very critical. And now we are doing programs with the American College of Business Court Judges. Thanks to Judge Platt, Judge Yates, and Judge Driscoll, who created the opportunity for us to do programs. Now we've put together a group at the NACVA that is the Judicial Education Group. And we have put together, and we've already delivered the first module, and we have 6 more on the drawing board, 6 more on the schedule, programs to present in terms that relate to the judges. What we're doing as valuation experts, what we're doing as damages experts, what are the challenges that we have? What are the levers that we can pull and push to guide what the outcome is going to be? What are the things that judges should be looking for? It was 2 weeks ago, we did a program. I was on the panel, Laurie Maston, Rob Carter, and Zach Myers, and our presentation was the SOAP, S-O-A-P presentation, standards of value, objectivity, assumptions, and professional standards. How do these mold and shape what we do in valuation, and how do they impact the outcome? We have other programs that are coming up that are on the schedule for the judges. They are designed for judges. These are not the programs that we as valuation experts would be attending, or that we as damages or other business litigation experts would be attending, but these are designed to enable the judges to better understand what it is that we're doing. We have, the next one is demystifying business valuation. We have one coming up on all experts. Not all experts are created equal. And the challenges that we have with experts going out into left field or right field, and how do you recognize which experts are telling it like it is, and which experts are rendering opinions that are based upon sound principles, sound evidence, sound methodology. reasonable assumptions. And we have one, a discovery and the financial expert, which is often a very, very challenging issue. So we're getting into the issues that we know that the judges struggle with from time to time, and we know that the judges want to know about. And we have some sessions on the drawing board that are just open discussion sessions where the judges can ask us whichever questions they want, and we can answer candidly. So I'm really excited about this series of programs. It's something that I believe it's valuable. It gives us an opportunity to give back to the judiciary, to give back, in thanks of the opportunity for us to get up on the witness stand and serve in our roles as expert witnesses in valuation, in damages measurement, in other types of business litigation. So stay tuned. You'll be hearing more and more about the programs. We have a lot of good things happening in that area. I want to add one thing, which is not it is not part of the judicial education program, but it is something that we may address: the issue of the calculation versus conclusion of value. And it's something that boggles the minds of many of us who do valuation in the context of litigation. And I've been approached by many, many of our colleagues, more than I care to count. And I've heard the war stories, the horror stories of what they've had to deal with in deposition and at trial when they have walked in with a calculation of value rather than a conclusion of value. And I think, and I'm sure, I more than think this, but because I realize what's going on. And I've got a lot of war stories, which I'm not going to get into today because I know I have a limited amount of time. But the one thing that I think gets us into the most trouble when we are walking into the courtroom and we are using a calculation of value as the basis for our opinions, we do not have a choice of whether to do a calculation or a conclusion. And often experts think they have a choice. If I approach from the standpoint of a calculation, it's going to be more cost effective for the litigant. I can get to I don't have to spend as much time. We can make assumptions and all of that. There is not a choice there when the expert is walking into an adversarial setting. The only reason in my mind, and I've seen what goes wrong when experts depart from this, the only reason that you would want to walk into the courtroom with a calculation of value is when it is humanly impossible to do the work necessary to formulate a conclusion of value. And that the impossibility usually revolves around someone on the other side of the case being obstructive and producing documents. The documents and the evidence that you needed to do a conclusion that meets the professional standard of care, it was just not available to you, and you can't do it. It's just humanly impossible. And if you use that rule of thumb, you're never going to walk into the courtroom with a product, with an opinion that is based upon anything less than your highest level of professional standard of care. Now, there are times in a litigation where there are opportunities to use a calculation. The other situation is where the people want to get the case settled, and everyone agrees that the plaintiff side and the defendant side, everyone has agreed with you, and they're all on board and have all signed off that you can walk in and do a calculation of value, and they're not going to challenge that approach. But short of that, when you're involved in litigation where there are people at odds with each other, parties at odds with each other, you walk in with that product that meets the highest standard of professional care. And with that,
Thanks,
Thank you.
Mike. Thank you. Thank you for that. And thank you to judges. We could go on, and I know we have 2 more segments left and everything. This is always such a good discussion. I hope that people will jump into the training, into the conferences, and attend these sessions because they're rich with information and wisdom. So thank you all. So with that, I'm gonna jump right to Jason LeRoy. We're gonna jump right into some standards and some of the key elements there. Jason, I'm just gonna let you introduce yourself and take it away. All right.
All right. Thanks, Mel. I appreciate it. My name is Jason LeRoy. I'm a partner at a regional accounting firm called Dorn Mayhew, based out of Michigan. I know that we're behind a little bit on time today, so I'm going to skip a couple of the slides to see if we can catch up a little bit. Today, what I'm going to go over is some of the resources that are available to our members, standards-related resources that are available to our members. So let me share my screen. And hopefully that's visible to everybody. So I'm going to skip ahead of a few of these slides because I want to catch up on the time. But what I'd like to do is explain quickly and show on the website where some of these resources are available to members. I've been a NACVA member for almost 20 years, and I always knew this information was kind of out there, but it wasn't until I was applying to be a member of the standards board that I really took the time to look at this and read through the information that's here and really understand it. And then once I was elected to the standards board, I went back through and really looked through everything with a fine-tooth comb. And there's a lot of great resources here that I want to make sure all the members on this webcast are aware of. So let me, what I'm going to do is just pull up the website. So here we are just looking at NACVA.com. And if you follow along with me, I'm going to click on this associations link. And there's a link right here called Professional Standards. And if you click on that, it brings up a whole host of fantastic information. Obviously, it starts at the top with the current professional standards. This used to be down in the page a little bit, and we just moved it up to the top to make it a little bit easier to find. So if you click here, you'll see a link to the current professional standards. So you can click on that, and it'll take you right to the current standards. Down here is a link to some of the recent changes that we've made to the standards. And then in this link, this tab below, you've got a list of historical standards. So going back to 2002, you can see the different versions of the standards that have applied going back almost 20 years. Some other resources here are we have a standards comparison chart. This is probably a document that's familiar to most of the members. We have 3 versions here, one from 2018, 2020, and 2022. The standards board is currently reviewing this current standards comparison chart to see if any changes are made. And if we do need to issue a new standards comparison chart, we'll hopefully do that soon and have that ready for the summer super conference. But what this does right here is this has all of NACVA standards, and it compares them to USPAP, ASA, and the AICPA. I know there's a lot of members that have to follow more than one set of standards if they're ASC members or AICPA members, and this is a great resource to compare the different standards. Also, we have here is an international standards comparison chart. You have 3 different versions. The last one was issued in June of 2022. And we're in the process of reviewing this to see if we need to update or change anything here. So here you have the NACVA standards, and we have them compared to some of the international standards. We have a comparison to the International Valuation Standards Council here. We have this comparison to the Royal Institute of Chartered Surveyors here, and then the CBV Institute here. So this is a great resource if you're trying to compare one set of standards to the standards of another organization. Another tool or resource that the Standards Board is in charge of maintaining is a glossary comparison. So we have two links here. One's to a domestic glossary comparison, then we have an international one. If you click on this domestic international glossary, what you can see on this left-hand side is a number of terms. And then if you see the NACVA accepted definition, if it's blank, that means that this is not included in the NACVA glossary. You have the definition of the International Valuation Glossary, USPAP, ASA, and AICPA. This is a great resource to see how the different organizations, what terms they recognize and what the definitions are for each of the organizations. And then there's an international one as well. So these resources are probably the most known and most, I would say, viewed of the resources that the Standards Board is kind of in charge of. But there's a few other ones down here that I think are great resources as well that I don't think I was fully aware of how much was here until, like I said, I was looking to apply to the Standards Board. Here's a link to some articles on ethics, and there's a lot of great articles here, and each one of them probably not overly lengthy. You could probably click through and read all of these in about an hour or so, but there's a lot of really, really good information. If you have an hour to kill, or if you want to catch up on some of your ethical standards, there's some really great questions and some really great information in these. Standards and ethics facts, FAQs. This is probably the most, in my opinion, one of the most valuable resources here. If you click on this link, we have this standards and ethical facts library. We have both litigation questions and litigation questions. I would like to point out that this is non-authoritative, but the way this is done is if we receive a question from a member, the Standards Board will review the question, provide an answer, and provide an interpretation. And if we think the question is relevant enough to the member base, we would put it here in the facts library. We've been talking a lot today about calculation engagements. The first question here is spot on. Are there situations in a litigation setting where a calculation may not be appropriate in lieu of evaluation? So here you can see the response from the Standards Board to that question. So you have a number of litigation questions here, and if you scroll down further, there's some non-litigation related questions here. Is a NACVA member required to follow USPAP, and some other great questions, which include the Standards Board answer and interpretation. In the couple minutes that I have left, I want to point out that there's this Q&A hotline. If you click on this link, it'll bring you to this site where you can submit an ethics question, standards or ethics question. You can put your name, your email. This can be anonymous, and then here you can provide some information on the question that you have, and hit submit. And it's a real easy submittal process if you have a specific question. This section provides information on different training resources. So if you click on one of these links to one of these workshops, it'll provide information on the workshop and some dates and times that those workshops are provided. Here's a link to some resource toolkits. If you click on this link, you can download, oops, looks like I have to log back in. You can download some information on templates and engagement letters. It's a great resource. Another great resource is this video library. I expect this clip will be up here soon, but this is just a video library of some questions and answers and presentations that have been done by Standards Board's members on various topics. So you can browse through those. And then there's a few other links down here at the bottom, which are also valuable. So like I said, I'd been a member of NACVA for almost 20 years, and it probably took me until just before I was elected to the standards board, until before I really understood what was here. But there's some valuable resources here, and it's definitely worth a few minutes of time to scroll through those. And with that, I'll turn it back over to you.
Thank you, Jason. Thank you for the presentation. So now we're going to have one of our polling questions. I apologize for the situation today. The panelists, make sure you don't close the polling question, but for everyone else, thank you for your patience, and we apologize again for that. And now we are going to have Garrett Wagner. He's going to talk about some information about how to grow and build our brand. And with that, Garrett, you can take it from here.
Elena, thank you very much. To all the participants, sorry about the problems today. I was one of the people that accidentally clicked close the polling thing on accident. So a lot of times it's some human error. Bear with us. And I've got 7 minutes. We're going to kind of hit the high level items on how to grow your brand, because you've been listening to some great knowledge here. You get tremendous knowledge from NACVA. And something I heard the judges say, thinking about how you're going to craft your own story. And very similar to how you craft your own story in like a deposition or on the witness stand, how do you craft the story of your practice? So when people hear you, you meet prospects, they're like, wow, like I want to work with that person. I can tell what they do. I know what's going on, and I'm super interested. Because too often we kind of miss that mark. You're not telling your story. A lot of times, especially those that come from the CPA background, we're just talking about taxes, and then we try and dabble in this stuff. So to give you some tips to talk about that, and I'm going to blow through some of the slides while we're here. So some common mistakes, like I said, high level, talking about how to grow your brand, build your practice, just not having a message, no cohesive thought process or what you want people to know about your brand, your practice, or you. Second error we see a lot is just kind of sounding all the same. A client might see 3 or 4 different people, to get a bid for a proposal. And if you all sound the same, no one's going to stand out. The client's just going to be like, oh, I tossed out the cheapest and most expensive and I randomly picked. That's not helpful. And lastly, the problem is, not knowing really what it is that you do. What makes you out there listening to this different than everybody else out there listening, or non-NACVA members, or somebody else? What is it? What makes you unique? And that's the starting point to grow your brand, to grow your practice, to grow you, so you can represent being the expert on all things of value. So we're going to start with some questions. I want you to I'm going to read them out loud. This is what we kind of help people go through when we do this with you. Kind of that first step. Before you craft that message, that story, that narrative, can you start to break it down? What's your value proposition? What's your why? Why did you found your own firm? Why are you doing what you do? Why did you join NACVA? Why did you get one of these specific certifications? Why? Can you explain that? And to start with, write it down. It's not going to be short. It's not going to be pretty. It's not going to be brief. It's going to be long and winded. Write it down. Work on it. Refine it. Think about what makes you different. What really is it? And it's okay. It's okay to be like, what makes me different? Like for me, avid cyclist, father of 3 young kids. Like those are the biggest differentiators in my life right now. So those type of things will appeal more to different people than others. Okay, that's one of the things that makes me different. That's real and authentic. And then lastly, why should somebody hire you? Think about that. Is there once again, is there a reason that you got into this? Is there a reason why you chose to be an expert on all things of value? What was it? Once you realize it, then you can start to work on it and to kind of craft that story, to think about it. But step one, that kind of like vision, you really understand like, why are you doing what you're doing? What is the story you want to tell? Step one, think about what that is. Then step two becomes, how do you tell that story? How do you get that perceived by customers, by prospects, by referral sources, by whatever it is? Now that you know who you are, how do you now craft that image that you want others to see you as? And then what can you do with different levels of content marketing and thought leadership to get that image across? You know, a great highlight today, and I'm stealing some nuggets from the judges there. You know, how many of you in the chat boxes were like, oh, I love the judges. They're so smart. They're so knowledgeable. They're so funny. I enjoy them. Yeah, what are you enjoying about them? You're enjoying a little more of them as a person than just a technician. So can you bring some of that out in what you're doing? Because what the judges are doing there, what all of us are doing here on these webinars is some form of content marketing and thought leadership, which is great to do once you know what you want to talk about. You know, we just don't want you to go out there far enough, talk about everything under the sun, every different group. Figure out who you are, what you do, what makes you different. And then based on that, you can find the right groups to talk to spread your message. So some things to think about with that. You know, once again, we're kind of peeling this onion down a few more layers as we go. If you've kind of narrowed out what makes you different, okay, who are these key clients that you want to go after? And I encourage you to spend a lot of time thinking about this, and you're going to refine it and you're going to work on it, and it's going to get better. But who are the clients that you want to target based in your practice? Maybe you've got an expert in forensic litigation. Maybe you're really good as an expert witness. We heard from one earlier today, expert in cryptos and NFTs. Like, that's their niche. Okay. Who are those clients you serve to? Where do they go for their information? What information are they looking for? And then how can you provide it to them? You know, like we're just thinking through the natural trajectory to starts with us. Who are we? What do we do? Who are we trying to attract to want to work with us? And then what are we looking for? And how can we create that connection between them? And that's really content marketing for the bonus landscape. And then, you know, the biggest piece of advice I'm going to give as I shorten this super in there, but you've got the slides, and a lot of times just you can kind of practice these. And then my email address is on there. So if you got some questions, email me. We can spend some time going through and I can give you some pointers. But the biggest tip with this, and the reason most people get to be successful, is they're willing to try. You know, that first time you spend all this hard work, you kind of write up what's my why, what's my value prop, what's my little pitch I want to give, or what's my first presentation like this I want to give. Your first one's not going to be your best, but don't be afraid to try. Don't be afraid to take that leap. Like, you know what? I'm going to try and do something different. I'm going to try and see how this goes. And it's okay that it's not going to be perfect. You know, that's the beauty of doing this. It's a little less nervous than being like, you know, the expert witness. You don't want to just try it out and see how it goes. You want to be ready. With this, you can ease into it a little bit more, practice with some friends, practice with some current clients, get ready, but don't be afraid to try. And if you can kind of do those things, which I condensed in there super big because of the time, you can grow your practice. Once you know who you are and who you want to serve as your clients, you can start to create your message so they see you and hear you, and they see you as an expert in all things of value. So with that, that is a marketing 101 in like 6 minutes to come in under the wire. So Elena, I'm going to kick it back to you.
Thank you, Garrett. Thank you for being so awesome with the time. So you already had the last polling questions for those of you that were looking for it. But we want to thank you for joining us, and we'll see you next month, June 19, in our next show. And we will have additional presentations, always with the newest information. And remember, if you haven't registered for the conference, you are still time to have some discounts. So we'll see you next month. Thank you all for being with us today.